Hello, everyone. Welcome to our monthly research call. I'm Ed O'Dowd of Capital Institutional Services. As part of a series we host every month with independent research providers, and we're happy to have everyone join us today. Clients that came back, welcome back, and new friends that are on the call. We welcome you and hope you get an enjoyable and informative experience today. We're excited to have back Markets Policy Partners, who does a great job at looking at the macroeconomic environment. They look at public policy, kind of how they intersect. And I know there's a lot to discuss in that world these days, the government shutdown and a whole host of other things going on. So we are excited to have them. Welcome, Brendan Walsh,
Good to be here.
and welcome, John Fagan.
Thanks very much, Ed. Great to have us. Thanks for having us back. We always enjoy doing the monthly CAPIS or quarterly, I guess, research discussion. We're at just for everybody out there, we're at marketspolicy.com. So you can find us there and reach out to us directly if you'd like to follow up on anything that we're talking about. Yeah,
Absolutely.
trade war. So
Yeah, get into it.
Yeah, let's start it off with the
go.
trade war. Essentially, the reports are, that in the background, some of these tariffs are being dismantled. We've seen the Trump administration looking to make deals. China is obviously is the focus here, and the upcoming meeting between Presidents Xi and Trump at the APEC summit the end of this next week is going to be what we think is, a relatively, relatively kind of predictable in terms of the way that the Trump administration has been dealing with China. We think that this is, there's a bit of brinksmanship here coming up. That's normal. But our expectation is that, the outcome of this meeting will be, from at least, the Trump perspective, very constructive meeting with President Xi. We made a lot of progress. There was a lot of understanding. He tends to come out of these in-person meetings, and particularly with, some of our, rivals, I guess, particularly, he's sort of had this, personal affinity for Xi, says nice things about him, obviously has respect for him. And so we think that the great likelihood is that on the backside of this, the threats of 100% tariffs and in early November get kicked. There's another 90-day extension, and the negotiations go on. Obviously the Trump administration is interested in making a deal with China. They certainly want to make a deal. It seems like they want a deal more than the Chinese do, and I think that centers on the leverage that the Chinese have. Everybody knows that we've been talking about it for a long time, and it's certainly very much in the spotlight here. The critical minerals, rare earth leverage that China has over the U.S. economy and very important strategic parts of the economy. So I'll kick it over to Brendan to dive deeper into that.
Yes, so obviously that's a big part of it. And now it's a couple of weeks ago, China really upped the ante on the rare earths. They added the other four heavy rare earth elements that hadn't been restricted. But they also, the big kind of announcement was, if you're exporting or importing, rare earth, you're not really importing rare earth. You're importing, the finished product, very much either, very strong aluminum or even bigger, the magnets. If that can be used in a dual use case where, you want to use it for a drone for your farming, but also a drone can be used for military, that's not acceptable anymore. And it's down to, even if there's 0.1%, Chinese rare earth elements. They also restricted all of their expertise and equipment for it, which really puts the rest of the world in a difficult place, not just the military, but, really the entire manufacturing sector. The additional constraints we just put on Russia, also with the oil, also brings in China, and a number of Chinese companies have been, restricted for their export import of Russian oil. China's not happy about that. So obviously, there's other things than just the U.S. Trade war with China that is involved with China, kind of playing their rare earth card. The thing I think the market doesn't fully understand and thinks that this is kind of something that Trump can just okay, we're going to make a deal, it's over. China for the last 5 years has been warning us that they're going to do this, that we're going to cut you off from using our rare earth expertise in the military. This trade war has accelerated this. So, in my opinion, and our opinion, the rare earths going into military use is not part of this negotiation. That is new policy and will be that policy forever.
Yeah, and the Chinese it's just really important, those points that Brendan made. And the Chinese in the past have made concessions, certain concessions on the rare earth, and said, oh yeah, we'll be filling in export quotas, et cetera, et cetera. In reality, it's saying one thing and doing another. And the Chinese have proven this again and again on this point. But the leverage is real, as Brendan said, and they are not going to be not going to be giving an inch. The non-negotiables in terms of that dual use that's really critical. So
Yeah,
the
and
efforts.
going into this meeting, there was headlines yesterday that the Trump administration is thinking about putting further restrictions on exports of U.S. semiconductors to China. That's not going to go over well in China.
Yeah, so the Chinese
It
have a
could be the
lot
right
of
thing to
leverage.
do, but I think the point is that we're not close to this battle being over.
Yeah, the Chinese have a lot of leverage. The U.S. economy, they think that the U.S. economy isn't in terrific shape. We'll talk a little bit more about that. We tend to agree with that. Not a catastrophe, but a softening economy and a stagflationary dynamic that is kind of a chronic. It seems at this point. They'll get back to that in a little bit. But the Trump administration just has they've got a lot more. They've got a lot more to lose in this negotiation if they can't come up with some sort of face-saving compromise. But that's the beauty of the Trump administration. The escape hatch is always declare victory loudly, right? The substance of the deal matters only so much in sort of Trump world, to be honest. The communications of it, the ability of the Trump administration to characterize it as a big win. And we don't think that the Chinese are playing such hardball that they wouldn't allow President Trump to have a modest compromise that deal that he can extol as the a fantastic breakthrough and a terrific win for his administration. So we think that kind of combination of the messaging ability of the Trump administration to sort of recharacterize whatever they truly agree as a huge win is something that gives him the kind of leeway in these negotiations that maybe another president wouldn't have, and looking like they're being pushed around to some extent by the Chinese, even if that is the case in this instance as well. We'll talk a little bit more about the messaging on the Trump administration when it comes to the government shutdown as well. We've just seen the expectations rising for the length of time for the shutdown. Now, the odds are for 40 days, more than 40 days. We're already in sort of record territory here. And the two sides seem pretty dug in, but there are some pinch points coming up that might be decisive in tipping the scales. So Brendan, when you think about some of the things that are going to heap pressure on one side or the other, what kind of stick out to you?
So on the Democratic side, obviously, it's about the rising cost of Obamacare. And on that front, the prices that you'll pay will go up next year, but you have to make your decision by the end of the month. Whether you're going to pay the extra or cancel your policy. So the time frame on that is fairly close, and you actually can't really. We're so close that it doesn't really necessarily matter if they cut a deal tomorrow. You would have to, as the government, kind of fix that in the summer to come to a deal on that. So both sides are kind of don't have a huge amount of incentive necessarily to cut a deal right now, because the consequences are there. I think that the soybeans could be a big deal. The farmers are starting to harvest right now, and they just don't have a buyer for almost half of their product. But bigger, the budget to for the farm aid is depleted. So if the government's shut down, you can't help out the farmers. So that could be a pressure point that could come to some sort of deal. Those are kind of the big ones. Other than that, I'm not exactly sure, in any short period of time, what brings these two sides to the table to reopen things.
Yeah, the temperature just isn't high enough right now, so it looks like for the near term that sort of dragging on with both sides entrenched. But again, we're in a position where the Trump administration is eventually it seems as though the Republicans will have to come to the table, and they again have that ability to message in a very effective way about what their big wins in this particular arrangement. Both sides are going to claim victory when it's all said and done. But when it comes to the kind of compromises that might be made, the Trump administration just doesn't really have to be afraid in the way that kind of a traditional administration would about really being called out, by its supporters, or essentially it's a very united caucus for the great majority of the Republicans on Capitol Hill, and they will message whatever compromise comes out as a big win, and they've achieved their goals, and whatever it is now, illegal immigrants cannot get health care, right? Which is they already really can't access a lot of it. So that's surely going to be in the messaging as well. So we think the near term really is about the still dug in entrenched positions, but eventually a more giving on the Republican side is likely to be part of the deal, but then it would be accompanied by great proclamations of victory and success on specific points. Yeah, in terms of other views, obviously the Fed, we've kind of had the view that the Fed would be more cautious than the market expects. I think that the dovish tilt has been, I think, a little bit more pronounced than we expected. The significant focus on the employment side of the mandate, the ability for the Fed, to even be to have the growth slowdown as a really critical justification for additional rate cuts. Despite the fact that they don't have the data that they usually are armed with going into these decisions, we've been, as I said, a little bit surprised at the dovish tilt. We think that on the margin over the coming meetings, the likelihood, we're still taking the under on the idea of the Fed cutting, into basically another 4 rate cuts in a row. Our expectation is that, Chair Powell is, looking at his term coming to an end as governor in May. And so the likelihood is that, we think that Powell is likely to be a little more cautious into next year. Maybe if he does cut in October, which we do expect now, if he cuts in December, we think that is teeing up for a couple of holds in 2026. Part of the reason for that is because, just the way that the political winds are blowing, whoever comes in after Powell is going to have to do some cutting, right? That's what the president wants. and you don't want to get off on the wrong foot as the new governor and not be cutting interest rates. So we think that, there's going to be plenty of justification for Powell to, be cautious coming into the new year. We don't think that the slowdown in the labor market is going to be so steep and decisive that they're, absolutely positively have to cut at every meeting. We think that the sticky inflation data and price, and sticky prices around tariffs and around, just some of the other stagflationary dynamics, immigration and so forth is, we think that that is, all else being equal, inflationary. So the expectation that we have is for the Fed to do the cut in October, get one last one in December, and then sit on their hands for a couple of meetings at the start of the new year and give the new governor coming in over the summer more leeway to cut and to take the rates down to neutral, or perhaps even below neutral over the ensuing meetings. And we talked a little bit about who we think the
exactly what's
governor's
going to happen in 2026 is hard. There's a lot of uncertainty in the global economy and things like that. So, certainly whoever takes over Powell will be more dovish than the current one, but exactly what the rate trajectory of rates, when we see at the end of 2026 is pretty difficult to predict.
And your guess on who it's going to be the new governor,
it's so early too. I don't honestly think the president has given a huge amount of thought. He's got other things on his plate. I would say right now, Waller and Warsh would be the two leading candidates. But it's a long time before the president has to make that decision. Yeah.
And it will certainly be someone who's on board with rate cuts, because we know that's what Trump. That's going to be figured out and vetted before.
Yeah, but I do think as it gets closer, the president's very aware of the market and in bad market reactions, and Treasury Bessent is very has his ear on that. So I do think someone that's so dovish that you would say, let's go to zero. I think when it gets closer, that kind of candidate will kind of get pushed out, because, the president he wants rates lower, but he doesn't want a market, meltdown,
Right.
And I think that's the other thing that, there's this kind of, unspoken tradition of outgoing Fed governors kind of doing a favor for their, if there's a hard policy choice that they have to make, they make it at the end of their tenure. Think back to Janet Yellen. Wasn't it like the start of, asset, quantitative tightening? There are some, there's that element of, needing to, if you want to do something difficult and you want to make the path a little bit easier for your successor, then, you want to get that in the last. And I think that that sort of hard choice that Powell would make is holding rates higher than they would be otherwise. And in fact, if you've got, an incoming governor that is going to cut rates, if the Fed skips a couple of meetings at the beginning of 2026, it's not going to change the market dynamics all that much anyway, because everybody will assume that those cuts will just be made up by the incoming governor, and then the incoming governor can then dutifully deliver those cuts and make the White House happy and have a good debut in the role, and not have rates already cut into so low that they're taking a larger risk by doing something like a 50 basis point.
Right. And I think the other thing that Powell, I think it's pretty clear to the market, but we still are doing quantitative tightening. I think at this meeting they'll end that. If you're beginning an easing cycle, it doesn't make sense to also be kind of shooting yourself in the foot by quantitative tightening. So, we'll keep the balance sheet kind of where it is.
Yeah, the big concern really would be that you get that inflationary, you get the inflationary dynamic, and the Fed makes a mistake by cutting too aggressively into an inflationary, uptick. That's our base case is that prices stay sticky, but don't run away to the upside because of demand, softer demand, and that there is a, sort of self-limiting dynamic for the inflationary impulse in the part of the stagflation equation, just because of that of the stag part of the equation, and we think that the weakness in the consumer at the lower economic echelons is creeping into higher economic echelons, and we think that the sort of wealthier, the wealth effect of stocks going up and so forth. If there's a pause in the rally, or a correction to some degree, I think that would be more growth impactful than your average garden variety market correction, just because of where we are and the softness in the rest of the consumer strata in the lower incomes.
And
Brendan, when you sorry, go ahead.
Has that been Powell's big hesitancy in the last couple of years of cutting? Is just such a fear of stagflation or inflation taking off again, kind of that double.
Yeah, I think it's the Fed was wrong. They thought inflation was transitory. I mean, it was somewhat transitory, but it went up way, way more than they ever thought it was going to. And you always know how to fix if we go into recession. You cut rates, you do quantitative easing. If you let inflation out of control and if inflation expectations go, the Fed loses all its credibility. So they kind of have to weigh the inflation mandate if it starts going up more than the growth. You don't want to be the next Arthur Burns. So I think that's what kind of has been in Powell's head, and not just Powell, a lot of their governors. So we're going to get because they brought back a few of the people that work at the BLS to do the CPI. So we're going to get that this week. And because it's tied to the Social Security checks, we need to know how much your Social Security check's going to go up. So we will get one data point from last month. And expectations are that, headline CPI is going to be 3.1%, which is, well above the Fed's target. So there are justifications for them being worried. Inflation is higher than expecting, but it's not so much higher that, if we really are, seeing significant job losses, that it justifies keeping rates, as high as they are right now.
Mm-hmm.
And we know, the housing market, really across most of the country is hurting, and obviously lower rates would help kind of get that going, where maybe someone's willing to sell and move off their 2% mortgage, and someone's willing to buy a $2 million house because it won't cost you quite as much on your monthly payments.
Absolutely.
Maybe pause for questions.
Yeah.
Anything in the chats, or?
I don't see anything in the chat. If anybody does have a question, please put it in the chat and I will read it to John and Brendan. I don't see anything in there. Real quick, one question I always bring up to you guys is the national debt. I guess we're around 37 trillion.
I think we passed it yesterday or the day before.
Okay, timely milestone. We crossed 37. Just bringing that up real quick, when does this become, you would think is an issue in terms of our GDP to debt ratio? Maybe we're on a par with other developed nations, but that being said, seems pretty high. The compounding factor of it, we could be at 70 trillion before we blink an eye, the way it's compounding. Debt service is an issue. So what do you guys think of all that? What is your view on how much of
and kind of going back to how the markets reacted, obviously gold and silver went a little parabolic here in the last couple of weeks. But when you look over the last couple of years, gold has massively outperformed. And usually why people buy gold is exactly that issue, and even crypto too has performed well. It's been, much more volatile, and actually gold and silver have outperformed it in recent. So there clearly is concern, both on the retail investors, but also, sovereigns. China is loading up on gold. So, the world certainly is concerned about it. But it's one of those things that people are predicting, a crisis of our debt, really since we started, accumulating debt, I suppose. So it's a very difficult one to predict, But
absolutely.
But the bigger point is there's no there's no political will to tackle that.
I've noticed.
Yeah.
Yeah, and one of the things that is coming up, obviously, is, this is part of what's kept longer dated treasuries on side with the despite the the big beautiful bills, decline in revenue, et cetera, and the deficits, tariffs. The revenue from tariffs, it's been something that the Treasury Department, Bessent, has pointed to, the administration has pointed to. I mean, this was one of the reasons why we thought that way back at the beginning of the administration, why they were so serious about tariffs is because they're casting around for other sources of revenue to try to fill up some of the holes from from the tax breaks and so forth. So that is now being reviewed at the Supreme Court, and so the idea of the potential for a shock if the Supreme Court comes out and rules the president has overstepped his authority on levying, a significant number of these tariffs under the emergency, that Emergency Powers Act that he's cited for, the authority justification to do that. If the Supreme Court comes out and says, nope, those tariffs are invalid, you got to pull them off. They don't have a revenue fallback. They don't have anything to, that would fill that hole.
Mhm.
And I think the best that they could do is just kind of try to repurpose, put more tariffs on, but under other authorities, find other ways to do it. This administration is pretty creative at finding those, but it would be a potential shock if the Supreme Court makes a decision and invalidates the tariffs, and you might see that 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 dynamic of not the Liz Truss UK to that level, but the idea of the bond market rejecting the fiscal plans of the administration if they don't contain tariffs. Now, my expectation is not so. I'm not a. I actually I am a lawyer, but but I'm not a constitutional lawyer.
You never. I thought you argued in front of the Supreme Court once.
No, I never did. I was a
All right,
boring
well,
corporate
let's hear it.
lawyer way back when in another life. But the the even back in the early 2000s when I was late 90s when I was a law student, I was cynical about the idea that the Supreme Court basically, like, you can justify most anything. You make a decision and then you back into it with you find the various laws to justify what you're doing. This Supreme Court has been the Roberts Court with the 5 conservative justice majority has been very fast and loose with their interpretations when it suits them to make those decisions. I think they hear the president loud and clear when he says that he wants them to make a decision that is administration friendly. They've shown a penchant for doing that, and and taking a very permissive interpretation of these kind of rules that would hem in the executive power. So my expectation is that with everything on the line, and all that the Trump administration has to lose with an adverse judgment, that this Supreme Court will not hand them that adverse judgment, that they will find a way, no matter how tortured their, legal analysis has to be, that these tariffs will stand. And that's, but it is a Supreme Court, and it has, they occasionally come out with pretty surprising decisions.
Yeah,
And
and kind
rulings
of big
pretty soon,
picture
right?
too for future administrations. The tariffs do raise a huge amount of money. If you're coming in and you want to get rid of them, that's a lot of money to give up.
That's a very good point. I didn't even think of the future. Let's fast forward, 4 years from now, you're inheriting a policy that's bringing in a lot of revenue. If we're using it to pay the deficit, even if you are completely opposed to it now and you're the other side of the aisle, how do you come in and dismantle it?
Yeah. Once you can run on things, but once you're in charge, you got to pay the bills, and that's a lot of money to give up.
It's a lot different than campaigning. Absolutely.
That's absolutely right. And the decision making in terms of the fiscal, the expectation would be, even if the Supreme Court comes out against them, they would just find another way. They would find another authority and put those tariffs back up.
And there are other avenues to do it.
Yeah, there are other ways to do it, and they would just do that instead of
and also, if the Supreme Court did rule against it, they have to return the money.
It would be a bond market shocker.
Okay, really? The money winding back to the start of this, whether it was
so every dime you raised was illegal, and it would have to go back to whoever paid it.
Okay, that has to be factored.
I mean, just a logistic nightmare, but also a fiscal nightmare.
Yeah, exactly. And a logistical nightmare. You hit the nail on the head. If there's any other questions, please put them in the chat. We got these guys here right now live and ready to go and answer any of your questions. If not, we thank you guys so much for joining us today. We thank our clients for being on the call with us today. We thank Brendan and John for giving us their insights. And I wish we could have you back sooner than 3 months from now, because every time we talk to you guys, so much has happened by the time you're back. It's like, wow. Then again, there's some like tariff issues that are still in inflation that we're still talking about. It's still the same broad themes, but there'll be no doubt a couple of elections coming up: New York city mayor, New Jersey governor. Those of all.
And we're getting into midterm election running.
Absolutely.
On that front, I didn't have Chauncey Billup being arrested by the FBI on my bingo card.
No, but like I said, there's enough data points every day that yeah, exactly. There'll be something else in a few days. So it keeps life exciting, but we shall see. Well, thanks a lot, guys. Really appreciate it. And thank you so much, everyone, for joining us today. Next month, on November 20th, Thursday, November 20th, we're going to have Fair Lead Strategies, Katie Stockton, and she employs technical analysis to chart a path for the market. So we're excited to see her insights next month. All right. Thank you so much for joining us, and everyone have a great day. Bye-bye. Thanks, guys.
Yeah, good to see you.
Thank you. Thanks for having us.
You got it.